Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, big jobs report out this Friday for the month of January. Let's unpack that and what the implications are. Equities have been red hot to start the year. US small caps finally showing some life. Why that might be important for an extension of this trend upward for 2023. And finally, bond market risk. We've talked a lot about that impact of risky assets in previous months. That is starting to move significantly lower and why that might be good for risky assets. So the jobs report just came out this morning. US January, you look across the board for economists, nobody saw this coming, right? 517 jobs were added in the month of January relative to last month. That is way more than the 187,000 jobs that were expected by consensus estimates. And prior months were revised higher by about 71,000 jobs across those months. So unemployment rate decreased. We actually had the labor market participation rate increase during the month. Despite that, strong jobs numbers, unemployment rate at a new 53-year low. So jobs market, the story of this bear market remains steadfast, remains very strong. On the chart here, we got a quick look at February 20 in the middle of the pandemic to now, and you can see real strong improvements across the board. Leisure and hospitality and services, the places that were most impacted, were still below sort of that the peak prior to the shutdown and pandemic in those areas, but we've seen significant improvement, and most of the areas across the economy we've seen growth relative to that February 2020 time period. Now, labor market participation, I talked about that inching up during the month of January, but if you forecast this out on the chart in the blue, we have that labor market participation rate, right? That's the percentage of people in the US population that are actively searching for employment. So if you retire, you don't count, right? They take you out of that calculation. They take you out of the calculation of the unemployment rate, regardless of whether you're employed or not. They don't count that. So the red dots are the projections based off the Bureau of Labor Statistics, the BLS projections from 2019. And you can see this trend lower, right? We see the bounce, the post-pandemic bounce as the economy rebounded. That was expected, but longer term, this participation rate based on the demographics of the aging population within the United States, more and more people will be retiring, and you're not going to see as many people entering the workforce at young ages that are leaving the workforce at their retirement age. And immigration has slowed during the past couple of years as well. So labor market participation, an important theme now, and will continue to be so over the next couple of years. Now, equities have started the year pretty strong, right? We had a really strong fourth quarter, and we've seen an extension of U.S. Equities rally, S&P 500 up around 8% to start the year. But take a look at this chart. We have the Russell 2000 small cap index. You've got 2,000 small companies within the U.S. versus the Dow Jones 30, right? Large cap industrial names. And on the chart is a relative strength chart. It's simply the price of the Russell 2000 small cap index divided by the price of the Dow. And what this chart shows us is when it's going down, small caps are not doing as well as large caps. And when it goes up, large caps are outperforming, small caps are outperforming large caps. And you can, number one, see the trend significantly lower since the beginning of not last year, but all the way back in 2021 is when we started to see weakness in the small cap space relative to the rest of the market. Big concern of ours to start 2022 was that underperformance. We have seen the tides change a bit as we start 2023. Take a look at that surge that we've seen, the most definitive outperformance during this downtrend. And I might argue even that we are breaking that downtrend as the relative strength line is surging above that 200-day moving average, a real strong sign for U.S. equities. And when you look at stocks, market breadth, right? How many stocks are participating? More than 70% of stocks on the New York Stock Exchange are now in longer-term uptrends. So we are really seeing a rebound in market breadth as well. And finally, to wrap it up, the MOVE Index, a measure of expected bond market risk. This started increasing again during mid-2021 as the Fed and the market started to forecast the Fed was going to start increasing interest rates. That was another concern of ours last year that is starting to subside. It's still elevated, but it's at its lowest level since March of 2022. Historically, equity markets and other risky assets do pretty well when this risk level is much lower. So that's a good sign for risky assets. And finally, before we wrap it up, 2023, we're a month in, but I was reading an interesting article about some of the predictions, not for this year, not for next year, but predictions from 100 years ago for what life would be like in 2023. Pretty interesting article. And some of these scientists back at that time predicted, I'll just start and go down the list. Cancer would be eradicated, right? They predicted most of the diseases that were plaguing those people at that time would be gone. Everyone would be beautiful. A pretty interesting insight. They just thought because of the technology and focus on health and beauty, everyone would get access to those, and we would no longer have a need for beauty contests because everybody would be beautiful. Highways in the sky was a big theme, right? They thought we'd have, I think, like anybody watching sci-fi movies, we've had a lot of flying vehicles with highways throughout the sky. Longer lifespans, some people thinking average life 100 years, even as high as 150 and 300, you had some scientists thinking. And then finally, the idea that a 4-hour work week would be the norm, partially related to the expectation that technologies like electricity and automation would basically lessen the need for employees and people to put in as many hours for the work week. So as I scan the list of these, there were a lot more than this, but my big takeaway is that everybody has no idea what 3023 is going to be like. And if we do predict, we're going to be wrong. So with that, I'll thank everyone for watching, and I'll see you next time.